So, good morning, everybody. My name is Ángel Estrada. I am the Director General Financial Stability Regulation and Resolution at the Banco de España, and I'm going to be chairing the closing panel of the fourth Conference on Financial Stability, and the panel is going to be devoted to the crisis management and deposit insurance in Europe. This is, you know very well, this topic has been very at the forefront of the regulatory discussions from some time, in particular with the European Banking Union. In fact, we still have the third pillar that is still pending to be completed, the deposit insurance for the whole Europe. And when we proposed this topic, basically it was related to the legislative proposal of the European Commission, that is, the name is exactly the same, crisis management and deposit insurance, that appeared, if I remember correctly, at the beginning of March. But given the turbulences that we have observed in US and Switzerland, that I think that could be considered a real test of the working of the resolution framework. I think that we will focus, or we will pay some attention to these events and trying to extract lessons for Europe, and also considering relation with the CNDI proposal by the European Commission. And for that purpose, together with me, I have three distinguished speakers. And let me introduce them by alphabetical order. On my left is Elena Carletti, that now is professor and dean for research in the Department of Finance at the Bocconi University, non-executive director of UniCredit Group. She is also director of the Banking and Corporate Finance Program at the CPR. Elena, you know very well, has published extensively in the fields of central banking, monetary policy, financial market, crisis, regulation, supervision, resolution.
That's enough.
just one additional thing. In her academic capacity, she has advised the European Parliament and the ESRB, that is the macroprudential institution for Europe. On my right is Cornelia Holthausen, that is the Director General of Macroprudential Policy and Financial Stability at the European Central Bank. Cornelia has held multiple positions during her career at the ECB, and now is the chair of the ECB's Financial Stability Committee. Cornelia has also a lot of a very good record on publishing a number of research papers on money market, payment system, and financial stability. And finally, last but not least, of course, Jesus Saurina, that is now a member of the Single Resolution Board, that is the resolution authority of the Banking Union. But Jesus, before joining the SRB in 2020, was the Director General of Financial Stability, Regulation and Resolution at the Banco de España, so my predecessor. And in fact, at the Banco de España, Jesus has developed most of his career. Jesus led Banco de España Financial Stability Department since its inception 20 years ago, something like that. And well, and Jesus has also extensive record of publication in specialized papers. And in fact, Jesus was jointly with Rafa, were the ones that put this financial stability conference in 2017. They started these conferences. So, welcome all of you. I would like to start the conversation with the panelists, asking Elena first, in the recent resolution cases, both public and private, and the private one, do you identify common patterns or lessons to be learned?
Okay, thank you very much for the kind introduction and for the invitation today. Actually, I'm very pleased to be in this panel with Cornelia, because X years ago, let's not say how many, both she and I were working exactly on these topics for our PhD, in our PhD studies that we did basically in contemporaneous. So it's very funny after so many years to be back on exactly the same topics. Having said that, let me start with maybe just putting the facts into context and then draw some lesson. We heard already yesterday in the initial conversation that Cornelia shared a lot of these things I'm going to say, but I think it's important that we are all on the same page. So let me very briefly revisit what happened in the case of the Silicon Valley Bank and the other two regional banks in the US, in the case of Credit Suisse, and then maybe one word of Deutsche Bank. That is something that happened suddenly on a day and then it was sort of forgotten, but I think in the mind of the banking sector that is not forgotten at all. So let me also maybe spend 1 minute on that. So let me start with Silicon Valley Bank. So what went wrong, what triggered the crisis, and what was done? And I'm going to do the same for both this case and Credit Suisse. So what went wrong was clearly, as we heard yesterday, a very strange, not to say weird, business model with this excessive maturity mismatch between assets and liabilities and the big reliance on uninsured deposits. But I think on top of it, there was also a poor risk culture within the bank, or at least that is irrespective of whether regulation was applied or not. I think we can say that this was also the result of poor risk management, because even if you don't have a regulatory constraint or requirement, risk management should have avoided such a risk profile. But we know that the regulation was relaxed in 2018, and on top of it, we also had a relaxation of supervision because the Fed did not even ask information on the liquidity position of this bank. So it was not just a regulatory issue, but it was also very much a supervisory one. So what triggered the crisis at some point was in the context of this outflow of deposits of the Silicon Valley incorporates that was going on for a while due to their liquidity reason. At some point, one day, Silicon Valley Bank lost 1/4 of deposits in a day. So that is an unimaginable speed of deposit withdrawals. And as a result of it, or also in contemporaneous with it, they sold the investment portfolio that they had in this available for sale, and they generated 1.8 billion loss. Okay? So what was done very quickly. In the span of a few days, the FDIC take over the bank, bailed in junior bonds and shares, not anything else, but those two components were bailed in. And importantly, for what I'm going to say in a minute, is there was the use of what in the US is called systemic risk exemption. Therefore, thanks to that, there was an extension of deposit insurance to all deposits held in SVB. And also, as Chair Powell said yesterday, the Fed started this bank term funding program so that banks could post collateral, and even if the market value of this collateral was lowered because of interest rate risk, the collateral would be valued at par. But this was done only after the Silicon Valley Bank case. So this is Silicon Valley, in very short. What happened to Credit Suisse? Well, Credit Suisse was in trouble already in the last years. We know they had a very speculative lending. They lost a lot of money with Green Seal and Archegos. They had poor risk management again. They had the poor internal control system again. They had the poor governance with changes of chairmen, changes of CEOs, and so on and so forth. And moreover, they had accounting irregularities, and the last result before the failure were released in a delay and with a significant loss. So yes, we had CDS failing in a few days, but the weakness of Credit Suisse had been going on for some time. This is not something that happened overnight. And it was not a surprise to supervisor because they knew, and everybody basically knew, that Credit Suisse was in this case, although they were on a recovery pattern. That is also important to say. So what triggered the crisis was there was a sudden increase in CDS at some point, in the CDS spread. There was a very significant drop in the share price, and that triggered outflows of wealth management clients and deposits. And what was done? Well, what was done, we know, on this dramatic weekend, the Swiss authority arranged the acquisition of UBS, again after bail-in. This case a little bit more questionable. We had the bail-in of shares partially, but of 81, and this was probably the first time 81 were bail-in in a going concern case. But importantly for what I'm going to say, we also had important public support. How was the public support orchestrated? We had government guarantees for 9 billion to UBS after UBS would bear 5 billion loss. So it was a sort of contingent government guarantees on taking losses. And then there was important liquidity assistance to both banks up to 100 billion with privileged creditor status, and to Credit Suisse up to 100 billion backed by federal government guarantee. So the public support may be on a contingent form, but was there, and it was massive, although in the press release, authorities kept saying this is a private solution. It's a private solution with big potential government support. A few days later, I think it was a week later, on the Friday, we saw Deutsche Bank losing 15% in the share price in the matter of a few hours, and then recovering again because it was Friday, speculators had to close their positions and so on. And what triggered this big share drop was investors in the US with 25 million moving CDS spread significantly because of the illiquidity of the CDS market. So with a very little investment, they could trigger this change in CDS, which then acted as a very bad signal for shareholders, and that was the start of the selling. And I can tell you that that was, I think, in the banking context in Europe, that was a very scary weekend, and it was very scary what would happen the following Monday when markets would open again, and luckily things stabilized. So what are the common patterns if I start from these very stylized facts? So ex ante, we can agree that there was a little bit of a relaxed situation. There was a relaxation of regulation in the US. There was a little bit of tolerance, if we want to call it this way, on the supervision side. And there was also poor risk management in all of these entities. But ex post, I think both jurisdictions acted very promptly. They avoided contagion, they avoided financial instability, also thanks to the use of public support or of the changing of some rules like deposit insurance or bond funding term and so on. So what are the lessons that I think we can take? And I'm sure that my colleagues will have many more, but let me just focus 5 for the moment, maybe 6 with Deutsche Bank. First, I think we can all agree that in a world of digital banking, bank runs can happen incredibly fast, and that we shouldn't be looking only at wholesale funding or on household retail deposits, as we are used to, but we also should focus a lot on corporate deposits, which over the last 10 years, they have increased significantly, also thanks to all the liquidity that was injected in the system during the pandemic and afterwards. So this means that the first thing, and this is very much on the debate now, what do we think about runs? Do we think them as being optimal? Do we think them as something that we should avoid? And we can discuss also later. On the one hand, we want to avoid the panics. On the other hand, we should maintain market discipline. So this is still always the same debate that Cornelia and I started studying X years ago. Then there is a discussion whether this means we need to extend the deposit insurance. Ultimately, this was done, in the US in particular, but it was done ex post. It was not done ex ante. So we can debate whether we need to extend the deposit insurance, eventually by how much and when, whether as a contingent solution or rather as an ex ante solution. Then I think we need to think about what does it mean digital finance for the whole crisis management apparatus, because clearly Credit Suisse has shown that the living wills in the span of a weekend are very difficult to be implemented. So what does that mean for that? Second lesson, we need to, I think we can all agree that in such circumstances, in particular with Credit Suisse, but I think also in the case of the American banks and eventually Deutsche Bank, financial stability needs to be preserved. What does that mean? First of all, that we may want to rethink the systemic risk assumption in Europe. In Europe, we have very limited use of that systemic risk assumption. If I'm not wrong, that is only used for precautionary recapitalization. So outside of resolution, outside, in just a very specific case, and just as a reminder, precautionary capitalization is when banks fail or perform or have a capital shortfall in the adverse scenario of a stress test. And then they may be asked to recapitalize, and then we can use the systemic risk exception to justify some public support. That was, for example, the case of Monte dei Paschi di Siena in Italy. That was a typical case that we saw a few years ago. But that is the only case. So it wouldn't apply to Credit Suisse in Europe. It wouldn't apply to Silicon Valley Bank and the others. So that is, I think, something to think about. But what I think is important is the importance of restoring confidence. So if it is not done through the use of a systemic risk exemption, there must be something in the crisis management framework that allows to restore confidence. Then I think another lesson is that, yes, we can focus on bail-in, but I think that we may want to reconsider, at least I would be of that opinion, public support. Because both cases of Silicon Valley Bank and Credit Suisse is not a resolution, but they underline the importance of using public support, in particular to manage things very quickly. So this emphasis that we had in Europe, and that is also underlined the new CMDI, on bail-in and exclusively bail-in and not taxpayer money, I think is politically understandable, but I think in practice it creates consequences that may be difficult to deal with. Fourth, and I'm almost finished, banks can fail for different reasons. What does that mean? We are used to think of banks failing for insolvency, but I think it's very clear that these banks, at least the final trigger, failed for liquidity problems, not for insolvency. And our resolution tools are not somehow depending on what is triggering a resolution. So the rules are the same, whether the bank is in problem because of credit risk, because of interest rate risk, because of liquidity problem. It's sort of not contingent on the reason of the failure. And I think that is maybe something to think about, because a bank that is failing out of liquidity may have assets that are much more worthy still than a bank that is failing for insolvency reason. So maybe public support is more warranted in one side and less in another, just to give an assumption. Then, lastly, we need to rethink about regulation and supervision. I think regulation, through SVB did not have liquidity regulation, but I think the assumption, and I think the chairman yesterday said as well, the assumption for the calculation of LCR and NSFR are based on some assumption like banks need to withstand deposit withdrawals in 30 days. But SVB said it's just a few hours. So are we happy with those regulations, or do we need to reconsider them? Then there is a discussion on capital regulation, whether it's more is needed, whether less is needed. I'm of the opinion this crisis is not about capital, but I'm happy to be contradicted. And then I think we need to put much more emphasis, as also the discussion yesterday underlined, on supervision, to give the tools to supervisor to be able to act actively. And I think, and maybe this is my board experience, we need also to look much more on risk management practices, internal control system. They are as important as the rules themselves, because if the rules are not well implemented, ultimately they're not going to be implemented. Lastly, Deutsche Bank. I think Deutsche Bank is a case that reminds all of us of the importance of liquidity in markets. At the time it happened, it reopened the debate of naked CDS. Then the debate was sort of stopped because there was again confidence in the market. But I think that a bank like Deutsche Bank may have a problem for an investment of 25 million. I think that is something we should reflect about. Sorry if I've taken too much time. Thank you.
Thank you, Elena. I don't know, Cornelia, if you have anything to add.
Yeah, this was very comprehensive, so maybe not so much. I'd say I agree on the causes, and I think also the Barr report, I think it outlined quite well the issues that took place at the bank level in terms of risk management and government practices. and also on the supervisory side, there were failures. They overlooked things, or they didn't react appropriately. But I think the regulatory framework is basically there, and in both cases wasn't maybe used as we all thought, as intended, and maybe that's because problems seem to be getting systemic much quicker than we thought. And then, of course, there's the scare on the regulatory and on the governmental side that things would become out of hand. So my colleagues at the ECB, they were saying, "Oh no, we have now been working on the regulatory framework for 15 years, and everything was in vain." So there was some frustration around the table, but I don't think it's that bad. So let me just compliment on a few things. So what are the lessons that we should take for Europe? I mean, some of the lessons will be taken up in the Basel Committee of Banking Supervision, as also Governor Hernández de Cruz said yesterday. So they will look at a global level, what lessons to be taken for both supervision and regulation. Then I think the systemic risk exemption that was applied both in Switzerland and the US, I think that's something we should consider also for Europe in these resolution cases. I fully agree there with Elena. So it's something we should consider. And then lastly, the bail-in of the AT1 that happened in the case of Credit Suisse, we didn't find it very helpful. No, I mean, I think many people were really surprised when that happened. But it appeared then later that it was possible and was according to the rules, but I think it didn't exactly make this instrument stronger, no? Because there are now lots of doubts about its applicability. It's a very complex instrument, and I think one should reconsider its role in going concern of banks. Then lastly, so I think in both cases we saw deposit runs, and so the research that we did back then, we used diamondific models, and their deposit runs are sunspot equilibria, no? They just appear like that. And I think in these two cases, they were not sunspot equilibria. There were very good reasons for run. So maybe, Elena, on the research side, you academics can start to look at it again, what it implies and what can be done. I mean, the FDIC had also put out a report, and apparently the US are now looking at various modifications to the deposit insurance framework, and I think that's something that's really important and worthwhile studying. Thanks.
Jesus, from the perspective of the resolution authority, or yourself, of course.
First of all, good morning to everybody. Let me thank Banco de España and CEMFI for inviting me to this conference. As you can imagine, it's a huge pleasure for me to come home and to see so many known faces. So thank you so much for inviting me in particular to this conference that together with Rafa we help to set up. I see that it's improving year after year. Maybe I will not make any reflection in terms of lessons learned from all these cases from risk management and corporate governance. I think that Elena has touched upon this issue very well. It is not for me to enter into this. I think that we've seen the basics of interest rate risk and liquidity risk forgotten for quite some time, and this is a bit surprising for me, but not to me to judge this issue. And also, I don't want to enter into reflections on the scope of regulation and the action of supervisors. Of course, I have my own views, but it is not for me to judge these matters. But I'm sure that there are reflections, and maybe it's more a matter of not changing the regulation, but applying it properly to the right scope and with the right intensity. But I'll come back to this issue because I think that Elena has thrown a big stone in the pond. So I think that we need to keep calm also, and see that we have a good framework in Europe to deal with issues, and not embark on 10 years reform of the frameworks for ending up not applying them at the end. So I think that we need to be a bit more careful on that. Then on the lessons, for me there are there are other lessons. I'll try to complement what Cornelia and Elena said. The first lesson is not a new one. We know it is there. It's liquidity in resolution. And I think that in Europe, in the banking union, under the remit of SRB, we have the SRF that can provide liquidity, but roughly now, as we are ending collecting this week, the contributions, the new contributions. So roughly speaking, we'll have around 75 billion of firepower. I think that this is an important amount of firepower to deal with small and mid-sized banks under our remit. Then governments agreed on the backstop to the SRF quite some time ago, but unfortunately there is still a country pending to sign for this. So once we have this, and we hope that this is signed the sooner the better, or promptly, we'll have much larger amount of firepower, not double, but close to it. And I think that this is a significant amount of money to potentially inject or to use in a resolution, either as capital and or liquidity support if needed. But it is true that say the Credit Suisse crisis shows that we don't have as much as 200 billion of firepower, and this is something that we need to reflect in Europe, and I think that we don't need to reinvent the wheel. We know which is the solution for this problem. There is only one guy in town that can provide the liquidity needed, but the thing is that we need to find a mechanism to guarantee that liquidity. So, and this is a thorny question and a complex question, but this is something that at some point we'll need to tackle. We can play as sometimes we do in Europe, basically wait for a crisis and then at the time of the crisis to deploy the needed instruments. But I think that this is, I find this approach, maybe realistic, but risky, because in the midst of a crisis, maybe it's not the right time to think about all the intended and unintended consequences of these frameworks. But I think that this is for me the first lesson. The second lesson is also not new, but I think it's more relevant for us, for the SRB and for the NRAs, and of course. Angel is here, but I am also very glad to see Paula here on the room. So thank you, Paula, for coming to this meeting. And I think that we saw, and I don't like to talk about, let's say, individual names or cases, but I think that in the case of Popular, Banco Popular, we used transfer strategy for the resolution. In the case of Sberbank last year, and by the way, Sberbank was under my remit because I'm responsible for Austrian banks, we applied transfer strategy as well. If you look at regional American banks, either immediately or after a bit of time, they applied transfer strategy again. And if you consider that Credit Suisse, UBS is a sort of resolution without resolution. It was also a transfer. So a transfer with an IPS and with liquidity support and so on. But no bail-in. You can write down and convert, but no pure bail-in. And I think that this is a very important reflection for us. So we demonstrated last year that in the case of Sberbank, we can arrange a transfer of a bank of 13 billion total assets. Okay, you may think that this is very small, but I can assure you that probably if you live in Slovenia or Croatia, the point of view is a bit different. Then we also demonstrated that we can transfer, or we can apply in resolution transfer strategies for a bank of 150 billion, like Banco Popular. We have seen in the US transfer tools for banks of 100 billion euros or US dollars, 200, a bit more than 200. But in the case of Credit Suisse, if you want to call this also a sort of resolution, the transfer strategy, with inverted commas, was applied to a bank of how much? 700 billion total assets. So it seems that the scope for applying transfer strategies and not bail-in is increasing. And I think that this is a very important lesson. At the end, in the weekend or in the long weekend, if you apply a moratorium, it seems that there is a much higher appetite for finding a buyer, a guy that can step in and provide the liquidity, provide confidence to the depositors, and keep the bank moving, protecting critical functions and protecting financial stability, which is our duty, apart from protecting taxpayers' money as well. So I think that we should reflect internally at the SRB level, at the SRM together, on whether if in practice most of the cases will be sorted out with a transfer strategy, maybe we should factor in this into our resolution plans, because we write resolution plans and we have preferred resolution strategies, and maybe it's the right time to factor in these issues into our preferred resolution strategies, or at least in the variant strategies in our resolution plans. I think that this has significant repercussions because transfer strategies may be a sale of the equity of the bank, can be an asset liability transfer, or can be even a bridge bank. And I think it's high time that us, together with each NRA under the banking union, we start to see whether we can operationalize a bridge bank quite quickly, whether we are ready or not. And I think that this operationalization of the resolution plans is key. And it's a bit of nitty-gritty for us, but it's a very important work. And I think that this should be much the focus of our work, more than starting to discuss whether the framework is fit for purpose or not, whether we should revisit liquidity, capital regulations. I think that we need to be careful with that, because we have a good framework, but we need to be able to apply it when needed. So it's a bit a word of caution. And then I think on whether a bit answering to Elena, probably this will be debated later. I think that overall the change in paradigm from bail-up to bail-in is a very positive issue. it is a very positive issue. So we need to be careful not to throw out of the window this change in paradigm now, asking for additional room of maneuver. Maybe on some exceptions, there may be exceptional situations, but I think that for an idiosyncratic case, we have the framework, unless it's a very big one, where probably the only tool is bail-in. I think that we have we need to have a bit more of confidence on the current framework. I don't have the feeling that many things are going to change in the U.S. as a result of this case, because you need the political will, and I'm not sure that there is a political will there to increase the coverage of deposits or to go for the uncover, because there is a key question here is who is going to fund the increase in the coverage. And this is an issue that cannot be skipped. It has an impact on the banks and has impact on the thing. So I think that of course we need to learn from all these cases, but jumping to immediately setting up working groups, setting up revisions of the frameworks when I think that the framework is up and running, and it touch wood, because every time you say nothing is going to happen and we are absolutely ready for this, you may be proof wrong in the afternoon. And for me, I'll stop here, but I'll come back, because I think that on the crisis of Sberbank, there are quite a number of lessons in terms of liquidity runs. Thank you.
May I come in on the liquidity and resolution? Or, sorry, because you said there's only one institution in town that can provide enough liquidity, and of course you're referring to central banks. And I mean, I agree that that the liquidity backstop is something that's needed urgently for a resolution case. I mean, you will have a bank that has been resolved over the weekend, and even though the resolution has been done well, it's not certain that the bank will get funding in the markets on Monday morning, no? So it will not have sufficient collateral in place, probably, or not so much, and market confidence is something that has to be established. And for these cases, of course, the single resolution fund can be needed, and there's a backstop from the ESM and so on, but I fully agree with you that the amounts are not large enough. We see that in the case of Credit Suisse, a much larger amount already would have been needed, and there was just one bank. What if you have a bigger problem even? So, so that's a situation where, yes, of course, a central bank could come in, and but it would have to, the liquidity provision would have to fulfill certain conditions. And in case of the European Central Bank, you have to provide adequate collateral. So that's deeply enshrined in our treaty, and that's something that we consider very, very carefully. And yeah, the bank and resolution may have exhausted it, but a way out would be if there's an acceptable government guarantee, for instance. So that's something that would enable the European Central Bank to provide liquidity against collateral plus this guarantee. And I think our institutions have worked a lot on solving these issues in past, in the previous years, and so far no solution was found at the time. So I hope that it's now again on the table that we can find a way forward, because otherwise for the ECB, I don't know, a treaty change might be needed actually to look at these things. And apart from that, enhancing the ESM backstop would also be welcome.
To hand it, I mean, the last thing that I wanted to do is to push you to lend without collateral, breaching. Not at all. It was. I tried to be let's say, as polite as possible, saying there is the central bank can provide this liquidity. Of course, it needs to be properly collateralized with guarantees, and this issue is the one that is thorny and complex, and happy to work with you, as we have done in the past. Exactly. On this
I understand, issue. Just for the audience.
And in particular for for the crisis cases where you really see the interaction with the ECB, and much appreciated. Now I realize that I forgot to mention what compliant told me. It's a must. I'm here not as a director of resolution as a staff of the SRB. I'm here as independent board member, so any opinion here is my own responsibility and not necessarily shared by the SRB or my other colleagues at the board. It's just only a clarification.
I think that Elena also writes.
No, I just want to say, in the same spirit of clarification, I didn't mean at all to say that we should go back to bailout regime, not at all. And if I gave this impression, I apologize. That was not the idea. Of course, the bail-in is a very positive change, and it should be maintained as a primary way of going forward. What I meant to say was more in conjunction with the systemic risk exception. So also government guarantees that you're also talking about with the liquidity. So this type of emergency situations where maybe we may want to rethink about the possibility of having some public support, at least on a contingent way, but not at all to go away from the bail-in framework.
Yeah, very relevant issues have been raised in this first intervention. Let's try to dig deeper in some of them. For example, the resolution tools. In Europe, at least, most of the effort were put in this bail-in. As Elena said, the resolution tools are not depending on the causes of the crisis. How do you see, Cornelia, this discussion between bail-in versus the sale of business, bridge bank?
Yeah, thanks. So right now the Commission has proposed a review of the crisis management framework, the CMDI framework, so crisis management and deposit insurance. And that will touch upon these elements now, and I think it's really very timely to look at these elements, because there are some things that we do think require some adjustments, and in particular, the framework has hardly been used over time, and I think it's because of its complexity and because there are some issues, in particular some are related to funding, and in particular, so shareholders and creditors are always have to absorb losses for at least 8% of a bank's total liabilities and own funds before the resolution fund can be used, and that's a very good requirement. But it can be challenging, particularly for smaller banks and mid-sized banks, because they rely a lot on deposits, and there are good reasons for why we may not want deposits to be bailed in, because it could also lead to bank runs and further financial stability problems. And another issue is that it's quite difficult to use the deposit guarantee schemes to fund transfer of asset and liabilities in resolution, like is possible in the US, and even though that could be a superior tool to direct depositor payouts in terms of their protection and also for financial stability. So we are of the view that that a reform is needed, and the purpose, the goal of the Commission is to indeed improve the funding tools and to manage crisis, to reduce incentives to use taxpayer money, and to strengthen the ability of the deposit guarantee schemes to be used in a meaningful way. So I think. So the ideas that were put on the table is to expand the scope of resolution relative to liquidation, for instance, also by considering the regional dimensions and implications for bank failure. So the idea is really that more banks would go into resolution instead of liquidation. But the issue is that more resolution would also require more funding, and this is why the possibility for deposit guarantee schemes to fund resolution has been clarified and strengthened, and more broadly, the role of these funds in crisis management has been expanded. And then very crucially also, the idea is to unlock funding from the deposit guarantee scheme, a single tier depositor preference would be introduced, and again, that's similar to the US. So for us, for the ECB's perspective, this proposal is very welcome, and we think it's necessary to a very welcome update to our framework, and so also the idea to expand the scope of resolution is much welcomed, because it also means that the smaller and mid-sized banks fall under this, this would increase the harmonized treatment of smaller banks in the EU and increase the level playing field. And we do think that in order to make this work effectively and incredibly for a larger set of banks, resolution funding needs to be ensured. And so it's very good that stakeholders and creditors have to bear first losses, and so that's why we have the MREL requirements, but these are really difficult to meet for smaller banks. And as I said earlier, if this would lead to a bail-in for depositors would be undesirable. So you need to find some alternatives for those banks that have difficulty fulfilling these requirements. I think there the Commission proposals are showing a good way forward. So first of all, to promote the use of the sale of business tool, so to transfer the activity to another third-party entity. But that requires some funding, and this here where the deposit guarantee scheme should and can play a larger role, and also to introduce the single-tier depositor preference will make it easier to use the funds of the deposit guarantee schemes. So all in all, we think it's a good way, a right step in the right direction.
Thank you, Cornelia. I don't know, Elena, if you want to elaborate a little bit, both of the resolution tools and also your opinion of the CNDI proposal.
So I agree that the CNDI proposal is a good step forward. I think is the expansion of the application of resolution, I think, is very welcome. I mean, I come from a country where this was very much a problem in the past, given that the country managed to somehow not to have resolution applied to some cases of crisis. So in that sense, I think this is an important step. I am a little bit more, I wouldn't say skeptical, but a little bit more doubtful on the use of the deposit guarantee scheme. And the reason, and although I share Jesus, I speak completely on my academic position and not at all UniCredit, but I have gone through contributions that the banks had to pay for the use of deposit guarantee scheme. And, and when looking at it, so let me maybe explain one thing. In Italy, we have the compulsory deposit guarantee scheme, and then we have the voluntary scheme, which is what is going to be used for helping other banks, basically. And of course, the bigger banks in particular participate in the voluntary scheme. First, because if they don't participate, there wouldn't be enough funding, probably. But second, with always the idea of avoiding then to go through the compulsory scheme to pay for the covered deposits, according to the principle of the least costly principle. I mean, while in principle this works well, I wonder to which extent this doesn't create a little bit of moral hazard, if I want to call it this way, of the small and medium banks versus the large ones. Because ultimately, it is a network of mutualization of help that is going to benefit mostly the smaller banks, but not the larger ones. So to some extent, and the larger ones don't get anything back. So it's not that they become shareholders, they participate in something. It's just gone for them. It's just a contribution that they completely lose. With the idea of, yes, not having to pay afterwards for paying the covered deposit, but at that point, they completely lose everything. So the only hope is that the recovery plans to which they contribute, or the resolution plans, will effectively not induce other losses for them. So that is my only doubt. Can we create a system where there is no potential for moral hazard from the small and medium banks versus the others in the system?
Mm-hmm. And Jesus, do you have an opinion on CNDI?
Well, I think it's CMDI, of course, it's a very good step forward, and we support CMDI, and we have tried to provide comments on the CMDI, technical comments that come from lessons learned on crisis cases and experience on applying the framework. But at the same time, it's a bit disappointing because there is no EDs there. But I'm sure that I will touch upon this issue later. So but I would like to take the opportunity to clarify a few things here, because I have the sense that there is a confusion between scopes and requirements. So the first thing we choose the tool for resolution, either bail-in or a transfer strategy based on its feasibility and credibility. Okay, and then it's not a matter that we choose a tool because of the MREL requirements that will come later or whatever. So it's whether the resolution strategy is feasible and credible or not. Then we go for the tool, and I think it's important to clarify this. The second thing is important to clarify that for resolution you need MREL, as Cornelia said very clearly. You need funding, and the funding comes from the capital, from the AT1 holders, the T2 holders, the senior non-preferred and senior preferred holders, and whatever it is needed and counted as MREL. And it's important to understand that this is needed for a bail-in, to absorb the losses and to recapitalize, but it is also needed for a transfer strategy and, of course, for capitalizing the bridge banks. And I think that this sometimes confuses a bit the debate. And then another clarification is most of the banks under our remit, and of course this is a statement at this point. When the crisis arrives, you need to carry out the new public interest assessment in that moment. But most of the banks under our remit are for resolution. There are a few exceptions where there are good cases, public development banks, other very tiny banks in very large countries, but most of our banks under our remit are for resolution. And you need, and I think that we have the mechanism for funding this through the MREL that we are asking to the banks, and if losses reach the 8%, we can inject capital using the SRF. So I see this discussion being opened up by the CMDI for the banks that are not under our remit, okay, for the less significant institutions, the LSIs. And here there is a clear trade-off. If national authorities want to have more resolution, as Cornelia said, and as the proposal is saying, we need to find funding for these additional banks that need to be resolved. And this funding will come from MREL requirements and potentially by the local deposit guarantee fund, breaching the gap to reach the 8%, and then therefore applying the SRF. So it's a bit a choice between resolution or liquidation. If the deposit guarantee fund loses the super preference, then in liquidation there will be potentially more losses for the local deposit guarantee fund. This is there is a clear trade-off. You want us to broaden the scope of resolution, to take more responsibility for resolution. It's fine for us, but we need to find the funding for this, and this needs to come via MREL requirements. And I think that the banks under our remit, if the markets are open, they are able to go to the market and raise the MREL. For the LSIs, this is less clear-cut.
Thank you. Let's come back to other element that explain, for example, the speed of the crisis. That is in the bank runs. No, the role that uncovered deposit play in these deposit rounds, specifically in US, and the decision that were adopted during the process in the weekend, basically, that helped in order to contain contagion and also to reduce the risk to financial stability. Jesus, in your view, and this is affecting not only LSIs but also significant institutions, what are the elements of the European legislation that could be addressed in order to improve our framework and make it flexible enough to address this sort of issues, if we need something, of course?
I mean, as I said before, building up of what happened in the US, and by the way, I want to be very clear here. My full support, my full understanding by the authorities that were involved in managing this crisis. This is managing a crisis is a very challenging issue. You don't have much time, and you don't have full information, and you find surprises during the weekend, and you need to deal with this. So absolute respect for all the authorities that had to manage this crisis. So this is the first comment. The second comment, I'm not sure how. I mean, I haven't read the whole Federal Reserve report and FDIC report on the crisis, but I failed to see how an increase in the coverage of deposits moving from 250,000 US dollars to, I don't know, 300, 500, how is going to sort out, how would have sorted out the problem at SVB or other banks. And then, regarding extending the coverage to all deposits, covered and uncovered, I see huge moral hazard problems here. So, and this is in a country that we were told many times about moral hazard during the crisis and so on. So now I think that we can seriously raise this issue as well. So moral, I mean, covering uncovered deposits, extending the coverage to all this, and then who is, and I would like to come back to this issue of who is going to fund this. Because if you extend the coverage, you will need to collect more contributions, right? So I'm not sure. I would like, and you ask about changes in the current framework. I would be prudent. I think that the CMDI proposal is a very good one. Let's try to advance this way. And frankly, I don't think that the discussion in Europe should be to increase the coverage from 100,000 to, I don't know, whatever, or to expand the coverage of uncovered. The discussion in Europe needs to be about the EDIs. This is the real discussion that we need to have. What is missing in the CMDI? This is the real discussion, not getting, let's say, focusing on things that probably. I'm not an expert on U.S. politics, obviously, but I don't see that this is going to fly in the U.S. And I think that we need to keep focus on what is missing in the European framework.
Elena, do you have?
No, I tend to agree with Jesus. I'm also not of the idea that expanding deposit insurance ex ante and unlimited is the way we should be going, honestly. But maybe going back to what Cornelia was saying before, just to rephrase a little bit theoretically, at least, where academia is on this topic. There are the runs, as Diamond and Dybvig, as we know, these are the panic runs. And eliminating them is costless. We know from the Nobel Prize paper that the mere announcement effect is eliminating them. So if we could distinguish the panics, and if we could make the announcement contingent on the type of runs, then we should be doing it. So we should just extend the deposit insurance once the run occurs, and that would be costless. The problem is we know that there are fundamental driven runs And for them, if you extend the deposit insurance, somebody has to pay for it, because of course these are instead the cases where the runs would not be stopped, probably, but even if the run would be stopped, somebody would have to pay the depositors at the end. So the two are very different type of crisis. So in practice, what it means is that to the extent we can't distinguish the two, or we cannot make deposit insurance contingent on the type of run, I share the view of Jesus that extending deposit insurance would increase moral hazard and would distort incentives. Then we can discuss whether this ex post announcement instead, as it was done in the US, would be warranted. But again, it depends on the type of runs we have, because we had the extension of deposit insurance in 2008 also, in particular in countries like Ireland, if we remember, to stop the runs. Ireland increased unlimitedly the deposit insurance, but because it was a fundamental driven problem and not a panic, this costed a fortune to the Irish government. So I share Jesus' view. As long as we are sure it's a panic, it's okay. But if we are not sure it's a panic, even ex post announcement can be very dangerous. But we need to deal with that. This goes back to my issue of we need tools to restore confidence if the crisis comes, and this is not an easy solution. An easy discussion. On EDIS, it's extremely disappointing, I think. I think we can say that. I was at the SRB last year when there was the conference on the 10 years of the banking union. And to me, it felt like exactly 10 years before. Risk sharing versus risk reduction, the same type of discussion. In a way, we would have hoped that, at least I would have hoped, that COVID, the next generation EU, would have led to more solidarity in Europe, to a little bit less North versus South, or these type of things. And instead, we are still there. In a way, there was really not a single step forward. And for what I understand, going forward, EDIS is not going to be easy, but maybe Cornelia knows more about it than I do.
So, please, Cornelia.
So on EDIS, that's such a big disappointment, really. I think we all share the view here, and I think that's purely in the political sphere, so all we can continue to do is educate, I think, our colleagues that are sitting in the finance ministries. We have an occasional paper at the ECB that also shows that even there, if you had an EDIS, there wouldn't be a systematic risk of cross-subsidization, which is the issue, I think, that the opponents are mainly worried about, but it's very difficult to make any progress here. So it's really terrible. So let me go back to the other issue that we talked about earlier on the usage of the deposit insurance fund. Now, I think it's very clear resolution is better than liquidation for the continuation of business for all the customers of a bank now. And I'd like to reiterate that it would really be good to use the deposit insurance fund not only in liquidation but also in resolution. But there's this least cost test that is very constraining. No? So the deposit insurance fund cannot pay out more for other measures rather than for the depositor payouts in a liquidation case. So relaxing, and here relaxing the super priority for the covered deposits would help to overcome this constraint. And this would allow to provide funds not only for the insured but also the uninsured, even in a resolution case. So overall, we believe it would be helpful for financial stability. And but it's very complex, and so to see that this could be the result of relaxing the super priority for the covered deposits. But so it's a complex framework that we have. Very generally, we think it would be good to expand and harmonize the use of the deposit guarantee schemes to finance alternative measures. So not only resolution, but also the sale of business, bridge bank, etc. And then thirdly, of the deposit insurance coverage, as I said, in the US, they're now discussing several alternatives. So would like a household, should they be treated differently from a firm? Because we're talking very different amounts and different purposes for holding deposits. And also maybe one can think of like a timely staggering of deposit withdrawals if we are in a situation of a crisis. So maybe not everyone should then be allowed to withdraw everything all at once, but I'm just brainstorming here. It's not the view of the ECB also. So let me stop here.
Thank you. So I think that if you don't have any specific remark, I think we can open the floor
to the audience. So I see one person there, Xavier.
Thank you very much. I think it has been very interesting. One question which I think is for Jesus, it's a thought experiment. What would have happened? I am thinking about the transfer, and the mergers as resolution mechanism. What would have happened in practical terms? I wonder several times if in the resolution of Popular we had not found any buyer. What do you think would have happened?
Well, thank you very much, Xavier. Having been your research assistant long time ago, I know how difficult is to answer your question. I don't want to answer this specifically in the context of this bank that you mentioned, but I think that what you put on the table is a very good argument, and we have asked ourselves many times what happens if there is no water in the swimming pool during the weekend, right? And if there is not a buyer, and maybe this has had a significant influence of our choice of bail-in. Okay, and most of the strategies focus on pure bail-in. Okay, but on the pure bail-in, you can also ask yourself if a very well-known and respected authority agency in Brussels, very well known in all the countries by all the depositors and so on. That's a very easy to understand thing called bail-in of a bank during the weekend, and it opens the bank on Monday morning. What's going to happen? So this is I'm just changing the question. I think that the arguments for the transfer strategy has to do first with being very well prepared for all the potential tools, but has to do with having enough MREL in the bank to absorb losses, therefore to create enough badwill to attract potential buyers, plus the synergies that the buyers may see in the operation because they operate in the same country or because they see a very good opportunity to expand or whatever. And I think that this is the answer to that. And if by the end of the weekend, assuming that the problem we can manage until Friday, and after applying a moratorium of 2 days, if there is no water in the swimming pool on Tuesday evening, then we still have the option of a bridge bank. Which basically a bridge bank is to win time to sell and to sell, let's say, for a fair price and not for a fire sale price. This can be done sometimes, this cannot be, and of course the sooner you get rid of the issue, the better. But this is how I see it. But your question, of course, it's a question that we put to ourselves every time we have a resolution plan in front. What happens? But I think that there are tools to have someone there willing to buy, but a prerequisite for that is to have enough MREL, and then to be prepared in terms of launching these processes quite quickly and as broader and as transparent as possible, inviting all the bidders and so on. And it's challenging. But for instance, in the case of Popular, it went well. In the case of Sberbank, it went well. In the case of the U.S. banks, it went well. So this gives me a lot of confidence in the tool. And then you need to think the day after. No? The day after, who knows SRB after a bail-in a pure bail-in in Slovenia, or who knows NLB, which is the largest bank there, that ended up buying the subsidiary, or Postal Bank in Croatia. I think that this is an element that we need to think as well, because sometimes we are so focused in ourselves that we think everybody knows us, everybody understands what a bail-in means, and everybody will buy this. And maybe sometimes it's better to be a bit more humble and to find a solution that has a higher probability of working. But MREL is an important element in this answer, preparation for the answer.
Elena, do you want to?
Yeah, just a quick comment. While I share what you said, I wonder, I mean, I think the sale of business is a very promising way to deal with the problem of banks. But then I wonder whether, again, to give incentives and to find a buyer, whether this may affect the timing when these solutions are taken, in a sense that, of course, the earlier you intervene and the less you leave the asset deteriorate, the easier it is to find a buyer. So in a way, should we wait until resolution? Should we try to have more early intervention tools? Shall we, can we deal with this in a going concern basis, or how do you see it? Because, again, I come from a country where, in particular in the past, we let banks really deteriorate before a solution was taken. This was years back, so I don't want to say that this is the reality now. But it was very tough on the buyers then to deal with that situation. So the earlier you intervene, the more likely it is that everything is solved to the better.
If I may on this, I couldn't agree more. It's a private solution before failing or likely to fail is much
exactly.
It's much better. And by the way, last year we had to deal with Sberbank crisis, but also we had another bank under our remit, and we were prepared to resolve it. But fortunately, the bank decided to wind down itself, and this is a perfect solution. It's not that I want to stay idle in Brussels, right? But this type of solution are much welcome private solution. And in this case, it worked very well, and protecting as well financial stability. And here, the governor of the country involved did a great job on that.
Okay, there was first one, Carlos.
It was discussed at the beginning the very relevant issue of the impact of technology on banking crisis, and it's true that they can increase the speed of a bank run, but this can be quite, or these have been traditionally quite fast in the terminal phase of a liquidity crisis. So, and in this particular case, the bad fundamental news about the solvency of the banks also emerged quite quickly. So it's it's not so easy to determine the differential effect of technology. So looking just at this terminal stage of a liquidity crisis, technology may also offer some solutions. For example, imposing some queuing process in the apps to withdraw deposits. That, of course, can help to crystallize the sunspot. But if you are already in a very advanced state, you could calibrate this queuing up to replicate the speed of traditional bank runs, giving the regulator some hours or days, 1 or 2 days to calibrate messages. More fundamentally, looking at liquidity requirements, another idea to think about is that they are more risk sensitive in some dimensions. So right now, if you change your balance sheet composition, that affects, for example, your outflows and inflows and affects your LCR, but maybe as a function of risks that you take, such as the duration gap, that could affect the expected outflow. I'm not saying that we should do this. I'm more asking whether we should put this in the drawing board and think about whether the liquidity requirements have a sufficient risk sensitivity. It's kind of a broad idea, of course, to be examined with a lot of care.
Do you want to react?
Well, let me, is that for me? I don't know for whom it was, but I like your idea of technology as potential solution to the problem that we have seen to the speed. My only worry, and I didn't mention, but I also think that one possibility rather than extending deposit insurance would be to limit withdrawals, so that the queuing that you are referring to. The only worry I have about this question is what this means for depositors in other banks, because if you know that you cannot withdraw your money, of course you are incentivized to go and withdraw earlier. We know that. So that is the only the negative side I see more with trying to stop withdrawals. But I think it is a way that one should explore more. On this liquidity requirement and risk sensitivity, maybe Cornelia knows more than I on this issue. So maybe I let her say.
I mean, on the first point, I think we have to really look for new solutions, no? And that's something to look into, because in the past, somehow, I think in most cases, somehow we managed to drag the problem to the weekend, and then the bank was closed, and then there were two days that were really available to deal with the issue, and this may not be the case any longer, no? But I don't have the solution. I mean, as I said before, maybe some staggered deposits or what you say to use the technology is the way forward, but indeed there's the contagion aspect that Elena pointed out, and then you would also have to put it in a well-placed framework. I mean, any intervention, because it's also like an early intervention, no? Yeah. And any early intervention we know can help to make the problem smaller, but you will also have to defend it. So no bank would like to have any of these measures imposed. And that you will have to prove it very well that it's really needed. And your second point, unfortunately, I didn't really get it on the risk sensitivity of the liquidity requirements.
I'm sorry, I didn't want to give you that.
So, for example, as a function of some of the risks to the solvency that the bank takes, you could also adjust the liquidity requirements. For example, if you accumulate a high fraction of realized losses or any other risk signal, then you might assume that this bank can face higher outflow rates, and then you adjust the liquidity requirements. This kind of modification to the framework that could increase complexity, but make the requirements more sensitive to risk. And again, this is something to be considered very carefully, so that's what I was thinking, whether we should put it on the drawing board, not like implement it in the short run.
Yeah, thanks. Interesting proposal. Now I understand what you want to say, and of course we would need to think through what it would mean, but I agree it would make the framework even more complex, so yeah, but thanks for the suggestion.
If I may, on very briefly, Carlos, I miss you. I mean, a smart guy that is here. So we've been working together, and I realize these two questions are very relevant. Just only one thing, and I think that I agree with Elena's answer on this, but I think that Cornelia raised the right point. All these things need to be done before failing or likely to fail, right? So you need the bank voluntarily wanted to step into this, or then you need to have to provide the powers to the supervisor to do this, and this is a thorny issue, or go into temporary administration, which is, as Cornelia said, triggers additional issues. This is something that can be reflected, but it's the bank, the one that has to implement it.
Rafa.
I was struck by a bold statement made by Jesus at the very beginning. He said, there is no need to revisit liquidity and capital regulation. Wow. Okay, on the liquidity front, I guess that Elena has already made reference to the statement of Chair Powell yesterday, but I would like to note one possibility that perhaps has not been discussed, which is to link liquidity risk on capital surcharges, which is something that, if you want to have a model of business that generates this potential risk, maybe a way to introduce incentives for reducing that would be to have some sort of additional capital that is linked to that exposures. And on the capital part, well, I think that the SVB case sort of shows that having these kind of accounting standards that allow to have significant losses in your bond portfolio, which can go on forever without any kind of consequences on your capital situation, I think is worrisome. And for many years, John Vickers has been advocated to use to have a more extensive use of market values in capital regulations. I would like to hear what you have to say on that. And since Jesus, you are going to say that your hat is not that of a regulator anymore, maybe Angel would want to say something on that.
Well, if I may, first, being publicly scolded by one of my most admired professors is hard. And at home, even harder. But maybe I was not clear enough. I still believe that what we've seen is not a matter of revising the framework. It's about the scope. I mentioned the scope. Okay, and this is the matter. Is you apply the regulation to which scope? Just only G-SIBs, or to other banks that we have seen, to the second tier, third tier of banks that we have discovered that can create financial instability? This is what I meant, trying to be as polite as possible. It's a matter of scope. Do you really want us to embark in a deep new discussion when probably it's a matter of whether you apply the framework and until where you apply the framework. So that was my humble comment. So we have seen now that second tier, third tier of banks can create financial stability, not only G-SIBs. Therefore, maybe one of the lessons is that the regulation, as we do in Europe, by the way, as we do in Europe, it's applied to any single, with a bit of proportionality, but to any single bank. But this is what I meant by this. Hope it clarifies.
Yes, and I fully agree with Jesus, as it cannot be other way. In fact, we cannot change the regulation because things that happen in banks that didn't apply the regulation that we had. We apply Basel III in general for all banks with a proportionality approach for smaller banks, but with all the regulatory ratios being followed for all the banks and being the regulation for all the banks. So lessons to learn, of course, but changing the full regulation due to these cases, I think is for example, things that are clear that should be reviewed, liquidity ratios, because when they were designed, probably internet was not was there, but probably was not used as it is used now. For sure, there were no APPs that you can use in order to move your deposit very quick. But I think that those are changes that should be implemented, but it's not changing the full regulation. With respect to the regulatory ratios that we follow, I think that is very important also to take into account or to include in the, or to use tools that allow us to be more forward-looking, because it's very clear that, for example, in terms of solvency, all the banks, at the moment in which they enter into troubles, the solvency ratios they have, they were quite good, or relatively good. But the projections that they have and that we have for those banks were very bad. For example, in the case of Credit Suisse, they announced losses for this year after having losses for 3 consecutive years. The solvency ratio was going to decline from 40 to 12 in just 1 year. In the case of Silicon Valley Bank, with a return on equity of a profitability of the assets of, if I remember correctly, 1%, between 1 and 2%, and a cost of the liabilities of 4%, it's very clear that that business model is not going to work. That was not reflected at that time in the solvency ratio, but probably in 2 years' time. So there are things that should be fixed, but changing all the regulation due to these cases, I think, is. And with respect to the putting more emphasis on the values, the market values of the assets in the balance sheets of the banks, I think it should be taken into account very carefully, because we are going to introduce a lot of volatility we could introduce volatility in the balance sheet. And one thing that we tried to avoid was procyclicality. So, I think it's something that should be considered, but it should be analyzed very carefully. I don't know if you have something to add.
Maybe just one thing. I think what this crisis shows is that the capital is important because it signals weakness. So, Credit Suisse, we can discuss also Deutsche Bank to some extent, are banks that were notoriously weaker in a way, no? And they were the Credit Suisse was and the Deutsche Bank is in a better trajectory now. But these are banks that we know have been weaker, at least than others, in the recent years. So in terms of capital being a signal for weakness, I would be in favor. I agree that is an important signal. Whether this means from the current crisis that we need to increase capital, I'm a little bit more doubtful. On the mark-to-market issue, I have only one question. I agree with him with Angel on the procyclicality, but I also would like to stress one other thing that we were discussing with Javier yesterday. Having a mark-to-market value of 85 because of credit risk, or having 85 because of interest rate risk, is very different. And the price is the same. So if you were to mark to market the security, you would put 85, no matter what the reason is. And on that, I would be very careful.
So I think, I don't know if there is a final question. No? So I think that with this we have come to an end. Thanks a lot, panelists, because I think that the discussion has been very insightful. Thank you to you because of your participation. And well, we finish here the conference that I think, as usual, has shown the high level of research that, for me in particular, as responsible of taking decisions on these issues, it's very important to have a lot of research that made my decisions easier and probably more adequate. So thanks to you, authors, discussants, the chairs for organizing the debates, and I would like to also thank the scientific committee, because I think they have had a very hard work selecting papers on very good papers. Rafa, that is the soul of the conference, and thanks also to protocol, communication teams, financial stability and macroprudential policy department, because without them it wouldn't be possible to celebrate this meeting. To all of you, good, bad, safe trip back home, and we finish here. I think we have a lunch prepared for us, so thank you to all of you.